Hi, everyone. Looks like it's 10 o'clock, so we're going to go ahead and get started. I want to welcome you all to our fourth and final webinar series that we've offered throughout the month of July. I'm really excited to have Robert Spendlove with us today, presenting this economic update that we have. As just a reminder, we're going to record this event and we will make it available on our UGFOA website within the next couple of days, along with all the slide presentations that were presented today. This event is worth 1.5 CPE, and I will have 3 polling questions that will be distributed throughout, just to kind of make sure everybody's staying engaged with what's going on, and it helps us track for that CPE credit. At the close, there'll also be a final survey that if you were needing that CPE credit, we want to make sure you get that filled out. It gives us all the information we need to send you your certificate of participation. So I know we're all excited to hear this information, so I'm going to try to make this quick. I'm going to go ahead then and introduce Robert, and he is a Senior Vice President and the Economic and Public Policy Officer for Zions Bank. In this capacity, he monitors and reports on economic indicators and public policy developments for the bank. Founded in 1873, Zions Bank is Utah's oldest financial institution, and it operates locations in communities throughout the Intermountain West. Robert's research interests are primarily in the areas of macroeconomics, demographics, financial markets, and public policy. He frequently advises and briefs policymakers, as well as business and civic groups throughout the United States. He's also regularly called on to give expert analysis in the media through print, radio, and television, and he's known for his insightful and understandable approach to explaining economic trends. Robert received a Master's of Public Administration with an emphasis in economic public policy at the University of Utah, where he's currently an adjunct instructor of public policy. He's married and the father of 4 children. Robert, we're super excited to have you with us today, and go ahead and turn everything over to you.
Great, thanks, Kimberly. It's great to be with you. It's a really interesting time to be part of the economy, to be studying our economic trends. And I'm just going to share my screen real quick. Can you see that? Okay. Thank you. We've been seeing some truly historic trends in our economy just over the last 6 months, and it makes it difficult as an economist to even fully understand what's happening, and especially kind of with an idea of what do we expect to happen. But so what I want to show you excuse me, during this presentation is just kind of walking through some of these historic trends, some of these changes that we're seeing. And one of the things I love about being an economist is every day the story changes. And for instance, just this morning, we got new numbers for national gross domestic product. And so I was actually working on updating the presentation just a few minutes ago. But and by the way, the other thing about my presentation is, you know, it changes every day too. So the coronavirus is really an example. It is the classic example of what we call a black swan. And it was unexpected. It was severe. It's had a dramatic impact, and it makes it very difficult to really understand what and how we're going to come out of that. And so it's forecasting is always tough, but especially when you've got environment and situations the way we're seeing right now. And so I'll kind of lay that out and kind of show you some of those slides. It's also required me to do a lot of work updating my slides because it's thrown off all my formatting because the trends have been so dramatic. But one of the areas where when we've got such a dramatic impact, it requires real commitment from the federal government to support our economy, both at the individual level, to businesses, and to state and local governments, to make sure that we have the resources to continue moving forward. And that's something that Congress is debating right now. So just kind of looking at some of those trends. So this one is our top line job growth. On the first Friday of every month, the Labor Department releases their monthly jobs report, and it'll be coming out next Friday. So it'll be interesting to see what we see. And this is kind of an example of one of those charts I've had to completely change. So if you look at those little bars across the top, those usually fill the page. But when we look at what's happened in the last couple months, it dwarfs everything we've ever seen. And to put to kind of show that, if you look over at the top left, for the 2 years during the Great Recession of 07, 08, and 09, we lost about 8.7 million jobs. And that was a huge impact, a dramatic impact. There's a reason we call it the Great Recession. And so that was 8.7 million jobs. In April of this year alone, we lost 20 million jobs. So the impact of that has been more than we've ever seen in our country, especially that quickly. Now, we have started to come back, and you see that in May and June, we added back about 7.5 million jobs. Again, those are historic increases. We've never had months with such big job gains. However, even with those 2 months of historic job gains, our overall employment situation is still down about 14 million. So there's still about 14 million people that are unemployed today, even with the big jump. So you can see how dramatic that shock has been on our system. When we look at where it's impacted, every industry, every major industry has been hit. The biggest one, of course, so what this is looking from February of this year to June. So what I wanted to do was kind of measure the entire impact so far that we've seen. And so our largest impact, of course, has been that leisure and hospitality. Even after we've seen some of those jobs coming back, that industry is still down nearly 30% at the national level. Natural resources and mining, because of the big drop in energy prices, is down 13%. Information is it's not really the tech sector. It's more newspaper production, television, motion pictures, and again, a lot of that has actually been the entertainment industry has really curtailed and pulled that down. But you see across the board, we've seen big decreases in our job growth over the last few months. However, there are some areas that are thriving. And none of these are surprising, but it also shows the change in consumer behavior. So on top, we've got our warehouse clubs, supercenters. That's your Costco, Walmart, Target. They're doing really well. And a reason for that is people, we still have to shop. We still have to buy food. We still have to buy our household goods. But people are more likely that what they want to be doing now is they want to be going to kind of a one-stop shop. They don't want to be browsing the mall or kind of window shopping like they have in the past. And so we saw a big jump there, big jump in couriers and messengers. When we don't have to go out, we're sending sending people to deliver our goods or deliver our different things. And then a little bit less of the impacts. You see the central bank is doing great because they've become really important. And then our building material, that's Home Depot and Lowe's. So while we see all major industries struggling, there are areas that are coming out strongly, and that's going to be one of the longer term trends that I'm watching really closely. Is we know that uh, historically, recessions tend to be disruptors. And so the result of a recession is many companies, and this is not just true with our current recession, but with all recessions, many companies will go bankrupt and will lose. But then companies that can identify opportunities can actually thrive and do better. I just heard a story this morning that Kodak, if you remember Kodak from Kodak film and cameras, Kodak has just signed a contract with the federal government to produce supplies for medicine for the coronavirus, and so that's an example of a company that is kind of changing their way and taking advantage of current situation and may be able to benefit from it. When we look at over time, you can really see how dramatic those impacts were. Our worst position, or the worst period of the virus, was in April. And you can see that the leisure and hospitality, so this is looking at the employment across industries over the last few months. We had a little impact in March, but then really hit in April. That's really when we had those stay-at-home orders and shutting down businesses, and the leisure and hospitality lost half of its workforce. Half of its workforce was fired or laid off during the month of April. Now they've come back, but they're still only about 70% of where they were before the pandemic. And then other similar industries. One of the interesting ones, since we've got a lot of people that work for government, the government has been much less than the others, but it's consistently been losing jobs throughout the period. And so a little more resilient, but also didn't kind of bounce back as much as the other major industries after the reopening in May and June. Our unemployment rate is another, and you're gonna see this theme across a lot of different slides. Again, we saw a historic jump in our unemployment. So this slide is going all the way back to 1948. I wanted to go back as far as possible. Our data goes back to 1948. That's when they started collecting this data series. And as you can see, we had unemployment. Now, it's hard to say that it's the historic high because we don't have the Great Depression. And I would guess that the unemployment from the Great Depression was higher than we saw in April. We topped off just under 15%. But it's higher than anything that we've seen in on our records, and not just by a little bit. We're really dwarfing everything we've ever seen. Now the unemployment rate has started to come down. We're down to 11.1% in the latest measure, but even at 11.1%, we're still higher than the Great Recession, and we're still higher than the recession from the early 1980s. So we're still at an extremely high level of unemployment around the country. When we look at the kind of the other measures of unemployment, you see some of these trends as well. So the underemployment, we call this U6 unemployment. So the blue one, the blue line is our top line unemployment rate. The green one is the underemployment rate. And underemployment takes in what we call the periphery. So it's people who are working part-time for economic reasons, or people who are kind of discouraged workers. They're not looking for a job now, but they would take a job if one was available. So that's your broader measure, and you can see that underemployment rate really spiked, going close to 25% in April. And that shows how dramatic this has been. I'll tell you, I was at a restaurant recently, and I always try to do research when I'm out and about. And so I asked the server how, kind of how things were going, and he said, well, luckily I'm receiving the enhanced unemployment, and kind of surprised me. And I said, well, wait, how was that? And he goes, well, as long as I work less than 19 hours a week, I qualify for the enhanced unemployment. So while he's not unemployed, so he wouldn't be in that blue line, he would be in that green line. He would rather just work full time and earn a paycheck. But because times are so tough right now, he is essentially constrained from earning a full-time paycheck because he can't work enough so he can qualify for the enhanced unemployment. But so that would be an example of that underemployed that is existing today. And again, even though we've come down, we're still higher than the highest level of the Great Recession. And then when we look at our kind of underserved groups in society, specifically African American and Hispanic and Latino, we've seen large increases as well in the unemployment rate. Big jump, especially if you look at the Hispanic and Latino, jumped up even higher than the African American unemployment rate. And they're now at about 14.5%. The Chairman Powell, Jerome Powell, the chair of the Federal Reserve Bank, addressed this issue yesterday. So the Fed met over the last couple days, and one of their major concerns is not just the overall unemployment rate, but these underserved groups. And he gave a startling statistic. He said that 40% of people earning $40,000 a year lost their job in the last few months. So while it's having an impact all around, it's overwhelmingly impacting kind of the low income and the underserved communities in our country. So, like I mentioned, one of the hard things with this is those trends are so dramatic, and it's hard to even keep up with the data and to be able to really see those trends, because the nature of economic data is we're measuring things that have happened in the past. For instance, the GDP number that came out this morning was for April. And so what we've been looking at are some of these high intensity indicators of economic change. So that's what this one is. This is initial claims for unemployment insurance, and this is a weekly measure. And so what we see is that in the in the green is that initial claim. And then the blue is kind of the green, the individual claims from each week adding up, and people that are staying on unemployment. So we see that spike again in late March, early April. That spike went all the way up to about 7 million unemployment insurance claims, dwarfing anything we've ever seen before. But then those continued claims just kept adding up and going higher and higher and higher, topping off at 25 million claims by the middle of May. Now, while those initial claims have been coming down, although in the last couple weeks they've started to trend up again, and that's one of the things that many economists are worried about, is we're starting to see a resurgence of the struggles again. But also, those continued claims have remained at a very high level, around 16 million continued claims. And so that's kind of related to that overall unemployment rate. So even though things are better today than they were in April, there's still tens of millions of people that are unemployed, and we're starting to see a resurgence in the virus, which has caused some states to start to curtail their economic activity and and slow down their expansions from before. When we look at Utah, you see a very similar trend. Going into the year, we had under 1,000 unemployment insurance claims. It was a very low number. And then almost immediately, right around, the shutdown was right around this period, that second week of March, spiked up all the way up to about 33,000 unemployment insurance claims. That it was a 1,400% increase in our unemployment insurance claims. And again, a level we've never seen before. It's been coming down, and a good thing is it's also been trending down. If you look kind of at the far right, we're continuing to see that drop. Well, nationally, we're seeing those numbers coming back up again. In Utah, at least until now, they've continued to kind of trend down, which is a good sign that the economy is continuing to improve, although it's at a much higher level than before. Let's see. When we look at our labor force participation, so this is one of the broader measures of our labor force participation or of our overall economy. And this is essentially saying if you take everyone who's working or looking for a job relative to the total population, that's your labor force participation. And so that took a huge hit coming into the recession. We essentially, now we didn't drop down to all-time lows in our labor force participation, but we dropped down to levels that we haven't seen since the early 1970s, as people kind of dropped out of the labor force. Now, we've come back a lot from there. We're now at around 61%, but again, we're much lower than we were just a few months ago. And and if you look back to the year 2000, that was when we kind of had our high point in our labor force participation, rising above 66%. The question is not only will we be able to get back to where we were in January, but how will we ever be able to get back to where we were in 2000? So that's going to be one of the struggles that we'll be kind of dealing with for years to come. But the one that really shocked kind of economists was this employment to population ratio. Now, while labor force participation wasn't the lowest ever, the employment to population ratio was the big. And if you look at this, this is a 1 month change. This change on the far right. It was the biggest drop we've ever seen, and the lowest level that we've ever seen. So this is saying what's the ratio of people who are employed to the total population, and the labor force participation stayed a little bit higher, because even if people lost their jobs, they stayed in the labor force and filed for unemployment. But this employment to population ratio dropped all the way down to about 51%. Now, again, we're back up to 54%. But if you look at that, we're still lower than we've ever been, even with this number coming back up. And so there are real struggles in people being able to find jobs nationwide. The result of that, now this is an interesting statistic, because we have definitely seen a big spike. So, and that's one of the things I want to point out is, as tough as things are and as bad as things are right now, heading into the recession, we were in an opposite position. And look at that. If you look at late 2019, early 2020, our struggle was we had a very tight labor market. We had fewer than one person for every job opening. And the economic fundamentals in our country were really strong. They were sound fundamentals going into the recession. And that's something I want everyone to kind of remember, is that if you think about past recessions are often caused by uh, internal inefficiencies or problems in the economy that kind of bubble over and cause the economy to slow down and contract. And you think about the Great Recession. There were the housing market and the capital markets had some fundamental struggles that pulled the economy into recession. The difference here is this is entirely caused by an external or exogenous shock to the system, that black swan event. And so it is certainly possible for us to return back to that level that we saw before. But you can really see that in our unemployed to openings ratio. So we jumped up, but it's interesting that we didn't jump up all the way to where we were coming out of the Great Recession. We had over 6 people for every open job in the coming out of the Great Recession. Our high point in April was just over 4, and now we're down to about 2.5, 275. So we're seeing some improvements in that area. Another one of the distorting areas, and this is a really interesting sign too. So part of the monthly jobs report, the Labor Department reports wage growth. And again, you can see that we've continued to have positive wage growth ever since the recession. It was somewhat slow coming out, so we're around 2%. Our long-term average is about 2.5% annual wage growth. Going into the recession, we had about 3.5%. And we were starting to see, kind of going into, in 2018 and 19, we were starting to see an acceleration of that wage growth, and then we saw it trending down. And then you just see that crazy spike in April. We jumped all the way up to about 7.5% in our wage growth. Now, the reason for that, though, is this distortion that we're seeing in the overall economy. So what we saw was those low wage workers were overwhelmingly impacted by the shutdowns. And so that skewed the wage growth up, because the people that were left were the higher paid workers, and their kind of pre-designed wage increases continued to move forward. And so we saw that drag the number up. And then as those low wage workers have been re-entering the labor force, it started to pull that overall wage growth back down. But it's causing some strange anomalies to our data. So this is the one that I just updated this morning. Gross domestic product is our broadest measure of the economy. Takes in all the goods and services produced by the economy. And again, this is one of those charts that just kind of dwarfs everything we've ever seen. The second quarter, the quarter that just ended, contracted by an annualized rate of over 32%. Now, this is by far the most severe quarterly contraction that we've ever seen. It dwarfs everything in the past. And so this is another sign. And I'm just seeing the stock market, the reason the stock market dropped so dramatically was because of this indicator, and also our weekly unemployment insurance claims, the data I showed you a few slides ago. Both of those are showing how dramatic the impact on the economy has been over the last few months. Now, again, I want to stress, though, that going into the recession, GDP was growing very strongly. Was averaging around 2 to 3%, and our economic expansion was the longest in our nation's history. We went over 10 years without a recession, and so the fundamentals were good going into it, but But the impact of this has been so dramatic. And look specifically, so, and it's even hard to even tell our components anymore because this is dwarfing everything. But there are components of GDP, different major parts that add up to gross domestic product, and probably the most important one is what we call personal consumption or consumer spending. So it is the consumer that keeps the economy going. Consumer spending is about 2/3 of the overall economy. And consumer spending throughout uh, uh, the last several years was holding up well, was continuing to grow. However, you can see in the first quarter, the consumer went negative, consumers stopped spending, and the economy contracted. And in the second quarter, consumers pulled back even more, which dragged the overall economy down dramatically. And so, kind of breaking that out, you can really see that. So, even though we saw drops in business investment, it wasn't enough to pull down or overwhelm the overall economy. But in Q1 and Q2, we see consumer spending drop by 6.9% in the first quarter, and then second quarter drop by 34.6%, and that dragged the entire economy in. And by the way, when I talk about being in a recession, that's another really unique thing about the current environment. Generally, recessions happen over a period of many months to quarters to even years. The Great Recession was, we didn't, 6 months into the Great Recession, we had no idea we were even in it yet. But this one has been so dramatic that the beginning of the recession has already been called. It began in March. Now, the end of it hasn't been called yet. We don't know exactly when that will happen. But there's a chance that because this has been so dramatic and so severe, that this could be the worst recession in our nation's history, but it could also be the shortest recession in our nation's history if we continue to see the growth that we're seeing right now. Consumer spending, again, is so this is what we call personal consumption expenditure, or PCE. And this is one of the indicators the Fed watches really closely. Again, you can see during the last recession, we saw a big drop in this consumer spending. And then we haven't seen as dramatic of that drop yet, but we do see that a drop in 2020 in that consumer spending as it gets closer to zero. Once those go negative, and I'll show you this also, there's two main measures of inflation that we follow as well. PCE, or consumer spending, is one of those indicators of inflation. The other one is the consumer price index. And so both of them are hovering really close to zero. And if it goes negative, that would go from having inflation to a deflationary environment in our economy. However, on the other side, we've seen personal savings have gone up to highest levels we've ever seen. And if you think about it, it kind of makes sense. Consumers were largely locked down, confined to their homes. Businesses were closed down. Now, we've all done a lot of shopping on Amazon, and we've all done a lot of shopping on Etsy, or all the different online retailers. But the shutdown, combined with economic uncertainty, caused many people to pull back on their overall spending. And what are they doing with that? Those extra checks from the government, or those extra unemployment checks. A lot of people are kind of putting that money away and saving that money. So we've seen kind of at the bank level, we've seen credit card utilization drop dramatically, and we've seen deposits increasing quite a bit over where they were historically. consumer confidence has been another one we've been watching closely. And this is another point of data that just came out. Now, going into the recession, we were seeing really strong consumer confidence. You can see that green line. Above the green line indicates that people feel like the economy is really good and that we've got a prosperous economy. And as recently as the beginning of 2020, consumers felt really good and they were continuing to spend. But then the impact of the pandemic has been so dramatic that it dropped all the way down to levels that we haven't seen since 2014. And now we're starting to see that come back up again. But then just in the last, in our last data point, the data that came out this week, consumers are starting to get nervous again. They're starting to hear stories of increased shutdowns. There's a lot of concerns about what's going to happen with when schools reopen in the fall, or will schools reopen in the fall. And so consumer confidence is starting to falter a little bit. That's one of our concerns kind of looking forward is what will the shape of the recovery be? And will we have a V-shaped recovery where it's a quick drop and a quick recovery, or will we have a U-shaped recovery where it kind of takes a while to kind of get back up again, or a W, and we often call that a double dip recession. And so we see that initial drop, we start to recover, and then it drops again, and we could have a series of those as the pandemic progresses. The worst case scenario is an L-shaped recovery where we drop and we never fully recover again to where we were before the recession hit. So looking at some of those areas, so in the manufacturing sector, it does appear to be a V-shaped recovery, at least so far. You see that again, the kind of critical area of this graph is 50%. So this is the Institute of Supply Managers has a manufacturing index, and they literally go out and survey them and say, are conditions good or are they bad? They have a series of different questions. And below 50 indicates a contraction in the industry, and above 50 indicates an expansion. And you see that it dropped down below 50. Look at during the Great Recession, there was a huge drop, but then and didn't come back until after the recession was over. And we saw a small drop in that indicator recently, but we've also seen a pretty quick recovery. So at least in terms of manufacturing, we are seeing that coming back again. But when we look at manufacturing employment, it's nowhere near where it was back in 2019, and part of that is part of that overall change, that fundamental change that I think we're seeing in society is we have the manufacturing sector has many more capabilities than they've had in the past, and so we're seeing them using automation more, using technology a lot more, and I think this will actually cause many of those changes to accelerate because of the situation with the virus, where people can't be in close proximity to each other, but we still have to produce the necessary goods for society. And so we may see this drop in manufacturing employment continue long-term, and a long-term trend of lower employment there. When we look at the service sector, we also see a dramatic drop, and also but a recovery pretty quickly. So again, more of a V-shaped recovery, at least in the service sector. And these are more like, I would call this more of a soft indicator, but it's an indicator of confidence in those purchasing managers. And so the purchasing managers in the non-manufacturing sector are feeling good about the current economic environment and are willing to kind of come back in again. So that's a good sign about the potential recovery of the kind of the goods producing and service producing sectors of the economy. Equity markets have also been surprisingly strong. We saw a huge initial impact as the shutdown happened, as we saw the government shutting down businesses, and they did enter. There's kind of two critical parts of or definitions in equity markets. A 10% drop is called a correction, and a 20% drop is a bear market. And so we entered bear market territory in all of our major indexes in the country, but they've come back strongly. And you look at the NASDAQ is actually higher today than it was pre-coronavirus. And again, that's a sign of some of those changes, those overall changes, while traditional industries have really suffered. Those industries that are what we're using now. I mean, think about it. We're watching this on Zoom. In the last week, I've done presentations on Zoom, on Google Meet, on Teams, and 6 months ago, I'd never used any of these before, and now we're all using them. And so you think about how the tech-heavy NASDAQ is benefiting from those changes. But even the Dow Jones and S&P aren't back up as dramatically, but have come up quite a bit from where they were at the trough. Oil prices. This is another one that has just been, I'll tell you, it was a complete head scratcher. So going into, and you can really see these interesting trends. I heard someone talking about 2008 when oil prices were at $140 a barrel. This was a oil commissioner in Texas, and they had a conservative forecast that oil prices would remain at 140 going forward, and they were strongly criticized for not projecting that oil prices would hit $200 a barrel. And so you can always see how it's so difficult to really have that perspective on what's going to happen. We hovered around $100 a barrel for many years, but then dropped down, crashed all the way down to $26 a barrel in early 2016. And then we were trending higher. We've been in kind of a tight trading range of between about $40 and $60 a barrel. And I was expecting that we would stay, and I actually do think that we're going to stay pretty close to that range going forward. However, then we get the coronavirus impact, and everyone stops driving, and all the planes are parked, and demand for oil essentially collapsed. And because of that, the price of oil went negative. And it's not only has it never happened before, but it's even hard to even understand. And it was it's kind of a complex reason for that. It's looking at futures contracts. I believe it was the May futures contract or the June futures contract in May, and it was essentially saying, because on oil markets you have to pay essentially for the ability to extract something or take something. And it was essentially saying those oil producers had to pay people to remove their product. This only happened for a day or two, but that shock was so dramatic, it pulled it all the way down to a negative $40 a barrel. Now we've come back, and we're back around that $40 a barrel again, but it just shows how dramatic that disruption was in that industry. So the response to this has been dramatic as well. The Federal Reserve, so just yesterday and the day before, the Federal Reserve met again, and they reiterated their position that interest rates will remain very low. So the Fed directly controls the federal funds rate, and it's that short-term rate that banks charge each other to borrow to maintain liquidity. And the question was asked from Jerome Powell, how long will interest rates, when will the Fed start increasing interest rates again? And this is a direct quote. He said, "We're not even thinking about raising interest rates." And so he wanted to stress so strongly that the Fed will do everything in their power to continue to be accommodative, to support the economy, to make sure that we have the resources we need to be able to pull through this. One of the things that every other meeting that the Fed has, so not this last meeting, but the meeting before, uh, the Fed governors essentially give a forward-looking expectation of where rates are going to be. We call this the dot plot. And so kind of if you look at that bottom, that kind of yellow highlighted dots, those are the votes from the Fed governors about where they think interest rates should be moving forward. And so what this says is that the Fed has no plans to increase interest rates above zero until everyone's voting for it in all of 2020, all of 2021. And in 2022, there are only two governors that think that we should start raising rates by 2022. So for an extended period of time, we will have.
Robert,
Yes.
it looks like we had one question come in, if you were okay to take that.
Sure.
What impacts in the labor force do you see with the extended unemployment benefits driving up? And are those extended benefits keeping people from wanting to go back to work?
Yeah, I'll tell you that is a really tough one, and it's a double-edged sword. So on its face, and the $600 a week is. So if you just look at it at the main level, yes, it is keeping people from working because that $600 a week, especially for those low-wage workers, is a richer benefit than they're earning at their job. For about 60% of people getting that benefit, it's more than they get paid on the job. Now, and so if we remove that benefit, in theory, people will return back to work. So that's what your kind of your model would say. However, there's another level to this, and the other level is what a lot of people are concerned about too, because that $600 a week unemployment benefit, I mean, let's just be honest, what is it? It is family support. We send out checks, and we also are sending out these unemployment benefits, and it's going to the lowest wage workers primarily, or it's having the biggest impact to low wage earners, and it's enabling them to continue to be able to survive. And now we do know that they're saving a lot of that money, but we also know that they're spending a lot of that money. And so the fear is that if that money runs away entirely, they go from 600 a week to zero. Well, it's not going to magically cause all those jobs to reappear. If you think about bars and restaurants and Disneyland and airlines, ending that benefit will not force you and me to go back to a restaurant, and it will not force you and me to go back on a plane or to go stay at a Marriott hotel. And so but what it will do is it will force those people at the very low income to curtail their spending and to need more help from the government in other ways. We've seen there's a close correlation between Medicaid rolls and recession. So we may see demand for Medicaid going up even more. So my fear is that if we end the unemployment benefit, we could actually see unemployment go up because the overall economy loses that support that is being provided from that benefit. Now, I do agree that the benefit has been too rich. I don't think we should be paying people more for not working than they get paid for working. And that's one of the real sticking points that the House and the Senate are trying to figure out. Some of the proposals I've heard is maybe a benefit that is 70%. of what they were making before, or or some kind of ratio. If you can't figure out the problem with making it 70% is that the administration is very difficult of that. So maybe instead of $600 a week, you make it $400 a week. But so I do think it is helpful to have that benefit continuing, but but we have to do it in a way that doesn't cause further distortions as well. So kind of back to the actions of the Fed, we're looking at, so again, there's the dot plot. If you kind of compare what the Fed was expecting to do, so we're looking at the past, really the past 4 rate setting meetings that the Fed has had. So we're going back a year. So a year ago, the Fed was expecting that in 2020, the Fed funds rate would be 2.1%, that it would increase to 2.4% in 2021, and then by the long run, we'd be up to 2.5%. And then if you remember last year, there were starting to be some signs of weakness certainly in the bond market. We saw an inverted yield curve. We saw some kind of fundamental weakness that spooked the Fed, and so they started to drop down those expectations a little bit. But as recently as December of 2019, they were expecting those rates to be about 1.6 this year, 1.9 next year, and 2.1 in 2022. And now you can see how dramatically that has changed. Although what's really interesting is you look back over on the long run, and the Fed hasn't changed their long run expectation at all. And I think that's just a reflection that they're saying, we don't know what's going to happen. And so we're just going to leave it at 2.5% and just kind of forget about that for now. But the Fed has showed that they're definitely committed to keeping those rates low for a long time. And why can they do that? So there's a direct relationship between inflation and interest rates. And if you remember, the Fed has what they call a dual mandate. And that dual mandate is that they have to focus on 2 things, which is full employment and low and stable inflation. And so in order to do that, the Fed has a target. So the Fed's specific inflation target is 2% inflation. And when it's above that target, so if inflation is above 2%, the Fed will tend to increase interest rates. When it's below that target, the Fed will tend to cut interest rates. And you can see that where the Fed was on a path of increasing rates for much of the last few years, as we saw that inflation going up. But now, not only is inflation not going, well, that's not true. In June, it went up a little bit. But the overall trend on inflation has been dropping, well, I should say slowing inflation. Now, and the reason I make that distinction is we have had periods where inflation has actually gone negative, where we've seen overall deflation. And during the Great Recession, that was from the housing crisis, because house prices dropped so dramatically. And then recently, in 2015, that was because of the drop in oil prices. Remember, that was where oil went from $100 a barrel down to $26 a barrel, and that pulled us into deflation. We haven't seen that yet, and I'm actually a little surprised that we haven't seen that deflation in our data yet, and that's just because while some areas have seen a lot of slowdown, housing has actually been pretty strong, and autos have been really strong. But the result of that, so if you look at the Treasury yield curve, is looking at the maturity of different bonds at different, or the return on different bonds at different time periods. And so looking back a year ago, we were seeing there's that sign of that what we call an inverted yield curve, because the Fed was keeping rates high but the market wasn't willing to keep longer-term bond rates as high as the Fed wanted it to be. And so the Fed started to drop rates. You see this about a year ago in August, the Fed started to push down rates. Now look what the effect has been from the latest drop. So our yield curve is all the way down. That far left, which is the close to the federal funds rate, is right around zero. But the effect of that is it has shifted all rates down, all the way from the very short Fed funds rate all the way up to the 10-year bond and the 30-year bond have now all dropped from dramatically from levels where they were. We also see kind of a flattening of the yield curve, much more than it was a few months ago. Another effect has been, so that 30-year mortgage rates are, interestingly, they're not based on the 30-year bond. They're based on the 10-year bond. And the 10-year bond continues to drop. And at the same time, we've seen 30-year mortgage rates fall to levels that we haven't seen in 50 years. There are, depending on which data source you look at, they're right around 3%, and some are showing rates even below 3%. We just haven't seen anything like that for years and years. And this is not by accident, right? This is one of the goals. This is one of the aims of the Fed, keeping those interest rates very low. They want to keep people buying cars, and they want to keep people buying homes and entering into credit cards and getting debt. They want to keep these economic activities moving forward, and so this is why they've been so aggressive in this area. They've also been buying bonds. So the Fed sets interest rates through their Federal Open Market Committee. They also literally go out and buy mortgage-backed securities, treasury securities, federal agency debt, and that causes, we call that the Fed's balance sheet. And you can see how we saw a big jump from the Great Recession. We call those quantitative easing, or periods of Fed bond buying, where we jumped from under $1 trillion in the Fed's balance sheet to $4.5 trillion. The Fed was starting to sell that off. They were starting to bring it back down, and then we got hit with the coronavirus, and now we've spiked up to $7 trillion. And if we have another, or when we pass the next federal stimulus, you'll see that number spike again. So we are seeing big increases in federal spending and in the Fed's balance sheet.
Hey, Robert, along with that right there too, we had a question that came in kind of after we talked about the unemployment stuff too, but with the spending there that you're seeing, can you talk a little bit about debt, the government debt, and this 26 trillion and counting, and how that relates kind of to the benefits conversation that we had with unemployment and the impact that may have overall with the economy?
Yeah, that's a great point. In fact, if it's okay, I've got a slide on that at near the end of the presentation.
You bet.
And I'll just quickly address that, which is, it's something we need to be worried about, but it can't be something we're too worried about right now. And that's the real struggle, and that's the battle on the next CARES Act is over that very issue. There are many people in Congress that are worried about an increase, a spike in our debt levels. And it is a valid concern, and I'll show you that slide at the end, but it is definitely a valid concern, but we have to be focused on the emergency in front of us before we can address the long-term concerns. But yeah, it's definitely a problem. So kind of looking at our local economic conditions, and as tough as things are, and as bad as things have been, even locally, Utah continues to be in a period of strength. not only in absolute terms, but also relative to the rest of the country. We're, again, the second fastest growing state in the country, growing much above the U.S. Population growth rate. The U.S. growth rate is about 0.5%. We're at 1.7%. The only state that grew faster than us last year was Idaho. And the nature of the population growth is very unique to Utah. While we have strong migration, we had over 21,000 people move into the state last year. Look at that natural increase. That's the green. We added over 31,000 of our population was our own children and grandchildren. In most states, that's a lot lower. And so that's something that's very unique to Utah. And it also kind of feeds on itself, because that's 31,000 people that are coming into the workforce, 18 years from now. And so it creates this strong dynamic that attracts companies that are looking for a growing workforce. And our total population topped 3.2 million last year. Where do we see that happening? And you can really see this, we call this a donut effect, where we have relatively slower growth along the Wasatch Front, Weber, Davis, Salt Lake counties growing a little bit slower, and then faster growth on those, it's called exurbanization, where we're developing lands that have previously been undeveloped. So you see that Utah County is part of that as well, mostly northern Utah County, but we're starting to see a lot more growth in southern Utah County as well. But then Wasatch County growing 3.1, Juab 3.3, Tooele 3.2. The kind of the Grantsville area is one of our hotspots for growth right now. And then, of course, our long-term trend of strong growth in Iron and Washington County continues as well. And this is not a new trend. This is kind of the nature of Utah's growth. Just to give a little bit of perspective on this. So this is showing all the way back to 1900, which is essentially when we have the data, and then forward our forecast for 2060. So it took Utah 119 years to grow our first million, to achieve a million population. It took 30 years to grow the second million. Then it took 19 years to grow our third million. So you can see how that exponential growth is heating up. Our projection is that we will reach 4 million people by the year 2035, 5 million people by the year 2055, and we should reach 6 million people in the next about 45 years. So you can see how that those numbers are continuing to increase strongly. And this is what we see. It's really interesting if you so I used to, back in a past life, I was in charge of the projections for the state of Utah. And the way we kind of studied what we expected Utah to see was we looked at recent history in other areas. So if you think about the growth of Los Angeles, that happened about 70 years ago, that kind of jumped over to Phoenix, and Phoenix saw explosive growth, and that jumped over to Denver, and Denver saw big growth. Now Salt Lake is going through that, and we're starting to see signs of that in Boise as well. So kind of we see very similar trends kind of across the West as they see these big growth patterns. Now looking at employment, we were on a really strong growth path coming out of the recession. During the last recession, we lost about 92,000 jobs, but we had strong growth for the past 10 years. Now, similarly to the national level, so and let me back up again, from December of 2007 to February of 2010, we lost 92,000 jobs. So that's, essentially just a little over a 2-year period, we lost 92,000 jobs. In the month of April, the state of Utah lost 140,000 jobs. Just to kind of show you how dramatic that change has been. Now we're coming back again, but that is a huge impact on our state. However, having said that, now every state is contracting. Every state is losing employment, but Utah's job loss is the lowest in the nation, dropping 2.7%. You compare that to, look at New York. New York is down 15%. So they're doing a great job, and this is one of the struggles. They're doing a great job of controlling the virus, but they're killing the economy. And Utah continues to kind of shine there. Looking at our industries, again, we're measuring, so this is kind of the broader February to June measure, big impact in leisure and hospitality. But look at the top. Construction is actually growing by 12%. And a reason for that is we're seeing a lot of new migration coming into the state from kind of the coastal areas that are still in lockdown and still in uncertain times. We're seeing a lot of demand for new housing in Utah, which is driving that construction growth. When we look at, so this is looking at over the last year, just kind of a broader measure, we see similar trends of leisure and hospitality being our biggest struggling area and construction being our biggest growth. When we look at where the jobs are growing, this is probably a little more timely indicator of our population growth too, because this is June 2019 to June of 2020. We see that pretty much every county is losing jobs except for Rich at 6.4 and Morgan is flat. But pretty much across the board, we're seeing that. But you see, especially those tourism-related areas or areas connected to energy and extraction are seeing our biggest impacts. Grand County down 9.4, Garfield County down 8.8. Those kind of specialized economies are seeing the biggest impacts. But then you've got, Salt Lake County is only down about 2.7, and Utah County down about 2.9. So those more diversified economies are not seeing quite as much of the struggles. The unemployment rate in the nation is the second lowest. So that continues to be good. Again, it's much higher than it was just a few months ago, but it's a lot lower than many parts of the country. Again, look at New York, 15.7%, Nevada, 15%, California, just under 15%, Michigan, Illinois, all really struggling right now. Massachusetts at 17% compared to Utah's 5.1.
Hey, Robert,
yeah.
maybe if you have, I don't know if you have a slide coming up on this too, but we did have a question come in too on what do you think the outlook is for taxable sales?
Yeah, I'll tell you, I don't have a slide on that, but I was really surprised that we have the TC23 that came in didn't show nearly the weakness that we were expecting. The income taxes fell, and I don't have the exact numbers in front of me, but I think that the Utah consumer has been much more resilient than we expected them to be. Now, the gasoline sales have been way down, but kind of across the board, we've seen a lot of resilience. And I think with us, Utah was one of the few states that didn't completely shut down, and people have started to kind of return back. Again, it all depends on the virus, and we don't know how bad it's going to get in the fall. If it gets really bad and we have to shut everything down again, that could make it tough. But I've been pleasantly surprised by our tax collections so far, and I think I do think we're through the worst part, and that we're now going to start to see it coming back. So looking at the unemployment rate, so what I wanted to do was just kind of show how dramatic the impact has been. So this is looking at January of this year. pretty much all counties had relatively low unemployment. When we fast forward to June, you can really see that impact, where those counties in the more energy dependent and travel and tourism dependent have really seen a spike in our unemployment rate. However, going into this, our unemployment rate in Utah was at a low that we hadn't seen for decades going into the recession. Now, we're much higher than we were, and it's again historic high in Utah records in April. But look how quickly we're dropping back down again. People are coming back into the job. We're seeing that unemployment returning back, and hopefully we'll continue to see that trend moving forward. When we look at our labor force participation rate, this is a really good sign. Again, remember the nation in green dropped dramatically down to levels we haven't seen since the 1970s and has not recovered from where it was before. Look at this. In Utah, yeah, we dropped down, but our recovery, we're now higher than we were heading into the recession. So we're actually starting to pull more people off the sidelines. I have to hand it to our Department of Workforce Services. They've done a really good job of standing up resources, of helping people get connected with jobs. Every time they send out their weekly report of unemployment insurance claims, they also say, and by the way, there's 25,000 jobs or whatever open jobs right now. We can help you get connected to those. So we're actually seeing some surprising strength from our labor force participation as well. When we look at our state GDP, again, all states are contracting. This is back to the first quarter. All states are contracting, but Utah's contraction is one of the lowest in the country. So we're definitely seeing those struggles, but not as bad as many other areas. And our personal income continues to be one of the highest in the country, growing just behind New Mexico and Idaho at an annualized rate of 3.8%. Our poverty rate is also the third lowest in the country. Really, you have to go all the way to Hawaii. Oops, excuse me, sorry, I bumped that. You have to go all the way to Hawaii or to New Hampshire to find a poverty rate that is lower than Utah's. And the reason, this is all just kind of helping understand the environment that we exist, and that even though things are tough, the Utah economy is fundamentally sound, and we've got good circumstances to emerge from the recession in strength. Home values in Utah have been rising dramatically and are now about 45% higher than the national average. As recently as 2006, Utah's home prices were the same as the nation, but we've been going up dramatically. And you can see that just kind of charting the growth rate. We had a big increase from 2016 to 2019. Those increases have been slowing down a little bit, but just in the last few months, we've started to see those accelerate again as more and more people want to move to Utah for kind of the quality of life. All those Google workers that have been sent home from their Silicon Valley jobs are coming to Utah. So, it's kind of that longer term trend of people working where they want to live rather than living where they have to work. And so attractive places like Utah and many parts of the West continue to grow. So kind of looking forward, this is looking at the question of how long does it take the economy to recover, or jobs to return to pre-recession peaks. We don't know the answer to that, but and it was a dramatic drop, but we are seeing big increases. If the economy can continue to recover and continue to get better, we could see. That's how I said it was, by far the worst recession we've ever seen, but if we can get a control of the virus, it could be the quickest recovery we've seen. Or we could see the path of the Great Recession, where we kind of they call this a swoosh recovery, where it takes a big drop with a long recovery. And that's essentially what the CBO is forecasting, is that it could take us up to 10 years to fully recover back to where we were before the recession. And then of course the big concern, back to the question that was asked, is yes, we need to take strong action to address the virus, but we need to be honest about what the impact this is having on our national debt. This is a projection from before the virus hit. And that projection was that we were already at essentially a post-war high in our national debt. And we were projected to pass that World War II, the all-time high in our national debt, by the mid 2030s, late 2040s. And now we've already added on $3 trillion of debt from the first CARES Act, and potentially another $1 to $4 trillion in CARES 2.0, and that will cause our debt to skyrocket even more. So it is definitely a struggle. It's something we need to be serious about, and we need to be very careful about our level of debt. But it's the focus right now needs to be on controlling the virus. But we've got to in the long term, we've got to get serious about handling our nation's debt and addressing that going forward.
Robert, along that lines, if I could, I had a question that I was kind of holding. You may have covered it, but I want to just put it out there in case. The question came up that said, do you agree with some of the new economic models and theories that say the government debt is not that important?
Yeah, so well, the answer is no. the kind of the theory behind that is modern monetary theory, or MMT. And they essentially say that debt doesn't matter, and that it's just a tool. And I've heard that theory my entire career, and I just disagree. I think a household's debt is just like a business's debt, is just like a government's debt. At the end of the day, you've got your income and you've got your debts. And if your debt is higher than your income, eventually you can't pay the bills anymore. And eventually your debt service is higher than your income. And when that happens, an individual goes bankrupt, a family goes bankrupt, a business goes bankrupt. And now, countries per se don't go bankrupt, but they lose their ability to kind of lead and grow. And you see that with Greece, with Portugal, Italy, Spain, have been running into these problems over the last 10 years. And yes, America right now is the strongest economy in the world. But eventually, if we don't rein in this debt, then the U.S. will cease to be kind of the world superpower. And so that's why while I do think it is important for us to do what needs to be done to control the virus, to address this black swan, we can't stick our head in the sand and say, oh no, it's different for government. Government doesn't need to worry about debt, because it is something we need to worry about, and it's something we need to get serious about. So kind of just wrapping up, what do we see happening kind of moving forward? Like I said, that the impact was something we've never seen before. Not only the degree, but the time frame. I mean, 1 month losing 20 million jobs. I mean, we've never seen it before, and we will never see it again. I hope you're, writing in your economic diaries. It looks like the worst is over. We're starting to come back, and I think again, there's so much uncertainty that we don't know for sure. But I don't think we'll return to how it was back in April. But those areas that have been impacted will, especially those ones that I've been talking about, those areas that require a personal touch, the travel and tourism, leisure and hospitality, eating and drinking, personal services, will continue to be hit for a significant period of time. And this is one of those disruptions, those long-term disruptions that will persist. And it may fundamentally change the nature of some of these areas. And we don't know exactly how that will be, but I think that's going to be one of the long-term impacts of this virus and of the recession, is that there will be distortions that will change how society operates. Also, and like I said, I think it is important for the feds, both the Federal Reserve and Congress, to continue to provide that support. The state wants to help as well, but the state can only do so much because the state doesn't have the resources. And so it takes both support from Congress and from the Fed. And of course, ultimately, the economy will be driven by the pandemic and by our ability to control the spread and ultimately address the virus through vaccines or other means. But and I want to leave you with this: as tough as it is right now, Utah continues to be in a really strong position. We were in one of the strongest positions. We had one of the strongest economies leading into the recession. And even now, as we're starting to come back out of it, Utah's economy is still fundamentally strong, and the nation's is fundamentally strong. And I have confidence that we will reemerge from this stronger and more dynamic. So thanks so much for having me.
Thanks, Robert. I did have one final question that popped up there, and I know that we're long, so if anyone has to jump off, we understand at this time the full recording will be made available. There was a question that came in on how can housing remain strong during this period, and is it a temporary bubble?
Yeah, that's a great question, and there's two dynamics that I see happening. I do not think it's a temporary bubble. I think there's two reasons that it's happening. On the national level, it's because those 30-year mortgage rates are so low. So that's a design. The Fed is pushing to get people to buy more homes and refinance their loans and keep that economic activity going. When you look locally, a lot of that is being driven by the recent trend of our higher level of migration. So we're seeing that continued population growth. A lot of new people are moving into the state from areas that are in lockdown or in uncertain circumstances. And this isn't just a Utah dynamic. We're also seeing this a lot in Idaho, also Arizona, Colorado. Kind of the Intermountain West is seeing strong population growth. And then the last part of it is even with this, so what I'm describing is demand. We've got high demand, but our supply is low. What you need land, labor, and capital to build a house. Our land is becoming more sparse. The labor is there now. We've got lots of labor, but capital, those supply chain disruptions are continuing. And so it's making those houses, we've got high demand, but it's making it more difficult to keep up with that demand, and that's driving those prices up.
Well, thank you again, Robert. And on behalf of the UGFOA board, we're really grateful for your time. Your presentations are always so informative, and we appreciate the value and the information that goes out to our membership.
Thanks. It's great to be with you, Kimberly.
Thank you. And then to our members too, I hope you found these series of webinars that we've offered through the month of July beneficial. And we look forward to maybe trying to find opportunities to bring some additional ones forward in the future. And we thank you again for your continued support. Everybody have a great day.